Welcome to everyone. This week video will be the third of a series of video on technical analysis. Before we start, make sure you read carefully the disclaimer. This series of video explores key technical analysis patterns that traders use to predict stock price movements. From classic reversal formations, like head and shoulders, and double tops to continuation patterns such as flags, pennants, and triangles, you will learn how to identify these visual cues on price charts. We'll examine the psychological factors behind these patterns, and explain how volume confirmation enhances prediction accuracy. Let's start by some very common pattern. Today's we will explore the double top, double bottom, triple top and bottom and the head and shoulder. Let's start with the double top. A double top is a classic chart pattern that signals a potential reversal in the price of a stock or an asset. It typically forms after a strong upward trend and is characterized by two distinct peaks at roughly the same price level, separated by a trough. This pattern indicates that buyers have attempted to push prices higher on two occasions, but have failed to break through a significant resistance level. How a double top forms. The formation of a double top begins with a price rise to a new high. Following this, the price pulls back, creating a trough. In the next phase, the price rallies again, reaching a peak that is approximately equal to the first high. This second peak is crucial. It reflects the market's struggle to overcome resistance. After the second peak, the price typically declines, confirming the double top pattern. Why it's happened? It shows that buyers tried twice to push prices higher, but couldn't break through resistance. This suggests weakening buying pressure. The volume analysis provide crucial validation for the double top. Typically, volume is high during the first peak, as enthusiasm reaches a maximum. During the rebound toward the second peak, volume is usually lower despite similar price levels, a warning sign of diminishing buying interest. Finally, volume often increases significantly during the breakdown below the confirmation level, indicating strong selling conviction and validating the pattern's completion. What to expect after a double top? Once the double top pattern is confirmed, typically after the price breaks below the trough created between the two peaks, traders can expect a continued downward movement. This decline often mirrors the height of the pattern, providing a target for potential price movement. To calculate this potential downside target, traders can follow these steps. When prices break below the support line, you can calculate the potential downside target by subtracting the support price from the highest point, then subtracting this difference from the support price. First, determine the highest price within the double top formation and the support level, which is the lowest point between the two peaks. Subtract the support price from the highest price. This difference represents the height of the pattern. I personally make an average between both high. In the example chart, the first high price is 6,099.97, the support line is at 5,773.31, and the second high price is 6,147.43. The difference is 6,123.70, 6,099.97 plus 6,147.43. Divide by 2, equals 6,123.70, minus 57.73, equal 350.39. To find the potential downside target, subtract this difference from the support price. Therefore, the potential target is 5,773 minus 350.39 equal 5,422.92. Psychological dynamics behind the pattern. This pattern represents a fundamental shift in the supply-demand relationship. During the first peak, some investors begin taking profits while others still believe in the uptrend. The subsequent decline doesn't immediately alarm most bulls, who view it as a healthy pullback. When price approaches the previous high during the second peak, the early sellers from the first peak often re-enter the market with sell orders, creating a resistance ceiling. New buyers become scarce as they observe price struggling at the same level twice. This increasing supply and decreasing demand caused the second failure and subsequent breakdown. Time frame considerations. Double tops can appear on any time frame, from 1-minute charts to monthly charts. However, patterns on longer time frames generally have more significance and reliability. A double top forming over several months on a weekly chart suggests a more substantial reversal than one forming over several hours on an intraday chart. Variations and nuances. Perfect double tops with exactly equal peaks are rare. More commonly, the second peak may be slightly higher or lower than the first, or the pattern may take longer to develop than expected. What matters most is that the resistance area is tested twice and rejected both times. Sometimes a throwback occurs after the initial breakdown, where price temporarily rebounds to test the broken support, now resistance, before continuing downward. This actually strengthens the pattern's reliability rather than invalidating it. The double bottom. The double bottom pattern is a bullish reversal formation that appears after a prolonged downtrend, signaling a potential shift from bearish to bullish market conditions. This pattern is essentially the inverse of the double top, and offers traders a structured way to identify when selling pressure is exhausting and buying interest is resurging. Double bottom develops in a multi-stage process during an established downtrend. Initially, price declines until it reaches a significant support level, creating the first bottom. At this point, buying interest emerges, often from value investors or traders who believe the selling is overdone, causing the price to rebound, typically rising from the low. The price then falls again, as some sellers attempt to continue the downtrend, approaching or reaching the previous low. Critically, this second attempt to push through support fails, creating the second bottom at approximately the same level as the first. After the second rejection, buyers gain stronger control, pushing the price up. The pattern is officially confirmed when the price rises above the peak between the two bottoms, the neckline or confirmation level. The measuring implications. Upon confirmation, the double bottom offers a quantifiable price target. Analysts measure the vertical distance from the bottoms to the peak between them, then project the same distance upward from the breakout point, same as for the double top. This projection is based on the principle that the momentum needed to reverse the prior trend will likely continue with similar strength. The psychological underpinnings. This pattern reflects changing market sentiment and shifting power dynamics between buyers and sellers. During the first bottom, early bargain hunters begin accumulating positions, while most investors remain bearish. The subsequent rally doesn't immediately convince most bears, who view it as a temporary bounce in a continuing downtrend. When price approaches the previous low during the second bottom, sellers who missed their chance during the first bottom try again. But their diminishing numbers can't push prices significantly lower. Meanwhile, buyers who saw the first bottom hold are encouraged to buy more aggressively. This decreasing supply and increasing demand caused the second bottom to form and the subsequent breakout. Volume behavior provides important confirmation for the double bottom. Typically, volume is high during the first bottom, as panic selling reaches its maximum. During the decline toward the second bottom, volume is usually lower despite similar price level. A positive divergence indicating weakening selling pressure. Finally, volume often increases notably during the breakout above the confirmation level, indicating strong buying conviction and validating the pattern's completion. Confirmation elements. Several factors increase a double bottom's reliability. The pattern forms after a substantial downtrend, not just a minor dip. The bottoms occur at a significant support level, previous historical support, round numbers, or major moving averages. The second bottom has lower volume than the first. The breakout occurs with notably increased volume. The pattern takes sufficient time to develop. Generally, the longer it takes, the more significant the potential reversal. Also, there is the triple top and triple bottom pattern. The triple top is a bearish reversal pattern that forms after an uptrend. It consists of 3 peaks at nearly the same price level, with 2 troughs in between. This pattern signals that the uptrend is losing strength, and the price is likely to reverse downward. The breakdown occurs when the price breaks below the support level at the lowest trough. The target calculation. The calculation mode is exactly the same than for the double top. Measure the distance from the lowest point of the triple top, the trough, to the peak formed between the three tops. Target price equals breakout point, minus the difference between the peak minus trough. The triple bottom formation process. Conversely, the triple bottom appears during a downtrend, when price falls to a support level 3 separate times, creating 3 troughs at roughly the same level. Between these troughs, price rebounds, forming 2 peaks. The pattern is confirmed when price breaks above these peaks after the third trough. The horizontal line connecting the 3 bottoms represents a strong support level where buying interest consistently overcomes selling pressure. The measuring implications. These patterns provide measurable price targets. Traders calculate the vertical distance from support line to the lowest trough, the highest peak within the pattern, then project this distance from the breakout point in the direction of the new trend. This projection is based on the principle that the momentum needed to reverse the previous trend will likely continue with comparable force. The next pattern is the head and shoulders. The head and shoulders pattern is one of the most recognizable and reliable reversal patterns in technical analysis, typically signaling the end of an uptrend and the beginning of a downtrend. The formation process. This pattern develops over time and consists of 3 peaks. Initially, the price rises to a peak, the left shoulder, during a bullish trend, then retraces downward. Next, buyers regain control and push the price to a higher peak, the head, demonstrating their last strong effort. After reaching this highest point, the price falls again, often to approximately the same level as the previous trough. Finally, buyers attempt one more rally. But their strength has diminished, resulting in a third peak, the right shoulder, that's lower than the head, and usually similar in height to the left shoulder. The lows between these peaks form what's called the neckline, usually a horizontal or slightly sloping line. The psychological factors. The pattern represents a gradual shift in market psychology. During the left shoulder formation, market sentiment is bullish, as buyers confidently push prices upward. The head represents peak optimism and the strongest buying pressure. However, when prices retreat from the head, it indicates that buying enthusiasm is waning. The right shoulder forms as some optimistic buyers try to maintain the uptrend, but their decreasing numbers can't push the price to previous highs. This reveals that market sentiment has fundamentally shifted. The volume analysis enhances the reliability of this pattern. Typically, volume is highest during the left shoulder formation, decreases during the head formation despite higher prices, a warning sign, and is notably lower during the right shoulder, confirming weakening buying pressure. Volume often spikes when the price breaks below the neckline, validating the pattern completion. Confirmation and trading implications. The pattern is considered complete when the price breaks below the neckline after forming the right shoulder. This breakdown confirms that sellers have taken control. The traditional price target is calculated by measuring the vertical distance from the head to the neckline and projecting that same distance downward from the neckline breakpoint. This projection is based on the principle that the force needed to reverse the trend will likely continue with similar momentum. False signals and variations. Not all head and shoulders patterns lead to significant reversals. Sometimes prices may briefly break the neckline only to reverse again, a head fake. Traders often wait for confirmation of the breakout, such as a close below the neckline or a break with significant volume. The pattern can also appear with variations. The shoulders might not be symmetrical in height or time duration, or the neckline might be sloping rather than horizontal. Time frame considerations. This pattern can form on various time frames, from intraday charts to weekly or monthly charts. Generally, patterns that form over longer time frames, weeks or months, are considered more reliable and may indicate more significant trend changes than those forming over shorter periods. Inverse head and shoulders. The inverse head and shoulders pattern is a mirror image of the standard head and shoulders, signaling a potential reversal from a downtrend to an uptrend. It's considered one of the most reliable bullish reversal patterns. This pattern develops during a downtrend and consists of 3 troughs instead of peaks. First, the price reaches a low point, the left shoulder, then rebounds somewhat. Next, selling pressure pushes the price to an even lower point, the head, representing seller's final strong effort. The price then bounces back, often to near the same level as the previous rebound. Finally, sellers make one more attempt to push prices down. But their diminishing power results in a third trough, the right shoulder, that's higher than the head, and usually similar in depth to the left shoulder. The highs between these troughs form the neckline, typically a horizontal or slightly sloping line. Psychological factors. This pattern illustrates a gradual shift from bearish to bullish market psychology. During the left shoulder formation, sentiment is predominantly bearish, as sellers confidently push prices downward. The head represents peak pessimism and strongest selling pressure. When prices bounce from the head, it indicates that selling momentum is diminishing. The right shoulder forms as some pessimistic sellers try to continue the downtrend, but they can't push the price to previous lows. This demonstrates that market sentiment is fundamentally shifting toward bullishness. The volume patterns significantly enhance this pattern's reliability. Typically, volume is highest during the left shoulder formation, decreases or may increase during the head formation, and is notably lower during the right shoulder, confirming weakening selling pressure. Volume often increases substantially when the price breaks above the neckline, validating the pattern completion and new uptrend. Confirmation and trading implications. The pattern is considered complete when the price breaks above the neckline after forming the right shoulder. This breakout confirms that buyers have gained control. The traditional price target is calculated by measuring the vertical distance from the head to the neckline, and projecting that same distance upward from the neckline breakpoint. This projection estimates how far the new uptrend might extend based on the momentum needed to reverse the previous downtrend. False signals and risk factors. Like all patterns, the inverse head and shoulders isn't infallible. Sometimes prices briefly break the neckline only to reverse downward again. To mitigate this risk, traders often wait for confirmation signals such as a decisive close above the neckline, increased volume during the breakout, or a successful retest of the neckline from above, where the former resistance becomes support. Due to the vastness of the topic, this video provides a brief overview by highlighting the most important points. For a more in-depth understanding, I recommend visiting my website, Tradingmarketcycles.com, where you can explore each subject in greater detail. If you enjoyed the video, please give it a thumbs up to support my channel. Share it with others, and subscribe so you don't miss any important updates. This concludes this week's video. Thank you for following along. And I'll see you next week with another exciting installment.